October 1979. Paul Tudor Jones, future billionaire, loses 60% of his account in a single cotton trade. One single trade. He could have quit. Instead, he learned something that would help him achieve 28 consecutive profitable years. The lesson? Stop trying to predict. Start playing probabilities. If you've ever had your stop hit right before the market reversed, if you've ever watched profits evaporate because you knew what would happen next, what Jones discovered after that devastating loss will transform how you trade forever. Because your problem isn't your strategy, it isn't your analysis. Your problem is you're fighting probability with certainty, and probability always wins. Welcome to Trading Psychology Stick, where we decode the mental game behind profitable trading. Quick reminder, this is educational content, not financial advice. Always do your own research and risk only what you can afford to lose. For the next 90 minutes, I'll show you exactly how Paul Tudor Jones rebuilt his career using probability thinking, why Jim Simons's Medallion Fund averaged 66% returns for 30 years using the same principle, and how you can implement their mathematical framework starting today. By the end of this video, you'll never look at a trade the same way again. Chapter 1. The Probability Blindness Epidemic. Here's a question that will reveal everything. When you enter a trade, what do you think? This will work? This might work. Or this has a 65% chance of working based on 200 trade sample size. If you didn't answer the third option, you have probability blindness. And you're not alone. According to broker data from 2023, 89% of retail traders lose money consistently. Not because markets are rigged, because they are trying to predict instead of playing probabilities. Let me paint you a picture of probability blindness in action. You analyze your USD perfectly. Price breaks resistance with volume, you enter long, the trade fails. Your brain whispers I was wrong, but probability says that was the 35% outcome. Completely normal. Next trade, you FOMO into Bitcoin with zero analysis. It rockets 20%. Your brain shouts, I'm getting better at reading markets. Probability says that was negative expected value. You got lucky. Here's what's happening under the hood. Our ancestors survived by recognizing absolute patterns. Eat berries, get sick, never eat those berries again. Simple cause and effect kept them alive. But markets aren't berries. Kahneman and Tversky's Nobel Prize research proved our brains see patterns in randomness and believe we can predict the unpredictable. We're using Stone Age software for Space Age problems. The 3 biases destroying your account. Confirmation, bias. The silent killer, your long Tesla. You consume 10 articles about the company, 9 bearish, 1 bullish. Which resonates? The bullish one naturally. Your brain literally filters reality to match your position. During 2008's meltdown, researchers documented this live. Despite clear systemic collapse, 73% of retail traders kept buying bank stocks. They focused on any positive headline while ignoring the apocalypse. Average loss, 84% of capital. Think about your own trading. How often do you switch time frames until finding support for your bias? Dismiss opposing moves as manipulation? Remember when you were right, but forget the disasters? Before your next trade, write 3 legitimate reasons it could fail. Can't find 3? You're not analyzing, you're confirming. Recency, bias. Why your last trade? Haunts you emit neuroscience shows your brain weighs recent events 3.5 times heavier than older ones. Not by choice, by design. After 3 losses, how do you feel about trade 4? Terrified. After 3 wins, invincible. Neither feeling reflects mathematical reality. You're not cold or hot. You're experiencing random distribution. Here's a sobering fact. With a 60% win rate system, you have a 6.4% chance of 5 straight losses. That's once every 16 sequences. Not rare, inevitable. Yet most abandon their edge after such streaks, right before probability swings back. Keep a running 100 trade scorecard visible. During losing streaks, seeing your actual long-term performance prevents panic. During winning streaks, it prevents hubris. The pattern addiction. This explains why traders draw endless lines, see head and shoulders everywhere, find meaning in every wiggle. More patterns feel like more control. They're not. They're noise masquerading as signal. The Journal of Behavioral Finance found something shocking. Traders using pure price action outperformed indicator addicts by 31%. Why? Cleaner decisions, less paralysis. Focus on what matters. Hard truth incoming. Markets don't see your support lines. They don't respect your triangles. These are frameworks for organizing probability, not controlling outcomes. The crash nobody predicted except probability players. October 19th, 1987, Black Monday. The Dow drops 22% in one day. Biggest single-day crash in history. Panic everywhere, except in Paul Tudor Jones's office. Jones made 62% that month. Not because he predicted the crash, because his probability models showed extreme readings. He positioned for volatility, not direction. When chaos arrived, he profited. Meanwhile, prediction addicts got cremated. Right about instability, wrong about timing, or right about timing, wrong about magnitude. Prediction requires perfection. Probability requires only positioning. This pattern repeats every crisis. 2008 financial meltdown, 2020 COVID crash, 2022 inflation spike. Probability players thrive, predictors get carried out. Quick question for you. Since 1987, we've had better computers, faster data, smarter algorithms, yet the percentage of losing traders remains constant at 90%. Why? Because technology can't fix probability blindness. Only changing how you think can. If these examples haven't convinced you to stop predicting, ask yourself, what makes you different from the 89% who fail? Until you embrace probability, the answer is nothing. Chapter 2, your first probability superpower. I'm about to hand you something powerful, something you can use on your very next trade. It's called expected value, and it's the difference between gambling and mathematics. Pop quiz time. Which trade would you rather take? Trade A, 80% win rate, average win, 100, average loss, $400. Trade B, 30% win rate, average win, 500, average loss, $100. Your emotional brain screams, Trade A, 80% win rate, but watch the magic of mathematics. Trade A, 0.80 times 100 minus 0.20 times 400 equals $80 minus $80 equals 0. Trade B, 0.30 times $500 minus 0.70 times $100 equals 150 minus $70 equals positive $80. Trade B makes infinite more money than Trade A, despite losing 70% of the time. This is why amateur traders chase win rates while professionals chase expected value. Finding your mathematical edge. Do you know your actual trading edge? Not your feeling, not your hope. Your mathematical edge based on real data? If you hesitated, you're trading blind. Let's fix that immediately. Step 1. Define your system with surgical precision. Vague rules create vague results. Your system needs rules so clear a child could execute them. Bad rules. Buy when momentum is strong and trend is up. Useless. Strong according to whom, which time frame, what defines up? Good rules. Buy when price closes above previous week's high. Volume exceeds 20-period average. Price pulls back to previous resistance turns support. Entry at rejection, candle close. Stop below rejection low. Target 3 times risk. See the difference? One is hope. The other is mathematics. Step 2. Gather your data. You need minimum 100 trades for statistical relevance. 200 is better. 500 is professional. But here's what most miss. Don't cherry-pick perfect periods. Include 2008 crashes. Include 2020 volatility. Include boring summers. Your edge must survive all conditions, not just favorable ones. Step 3. Face reality. Calculate these metrics without mercy. Win rate, total wins divided by total trades. Average win, sum of winning R multiples divided by wins. Average loss, sum of losing R multiples divided by losses. Expected value, win rate times average win minus loss, rate times average loss. If your expected value is negative, you're not trading. You're donating to better traders. Real traders, real numbers. Let me share what actual traders discovered when they calculated their edge. A futures trader bragged about his 75% win rate. Then he did the math. Average win, 400. Average loss, 100. Expected value, minus $50 per trade. He was slowly bleeding out with a winning system. An options specialist complained about losing constantly. Win rate only 28%, but average win was 2,400, average loss 300. Expected value plus $450 per trade. She was getting rich while being wrong 72% of the time. The lesson: your feelings mean nothing. Your win rate means little. Your expected value means everything. Let me prepare you for something. Trading a 30% win rate system is psychological torture. 7 losses out of 10. Your spouse questions you. Friends mock you. You question yourself. But Ed Thorpe, who beat both Vegas and Wall Street, had systems that won just 40% of the time. Yet he retired wealthy. How? He understood this. You don't need to win often. You need to win big when you win and lose small when you lose. Think about insurance companies. They lose on most policies when nothing happens. But when they win by collecting premiums without claims, they win big. When they lose by paying claims, they lose controlled amounts. Positive expected value despite low win rate. Your trading should work identically. Many small losses, occasional large wins, positive mathematical expectation over time. But knowing your edge is only half the equation. The real question is, how much should you risk when you have that edge? Chapter 3. The Kelly Criterion Revelation. In 1956, Bell Labs scientist John Kelly discovered something so powerful. Casinos tried to ban people who used it. Ed Thorpe used it to beat blackjack, then made millions in markets. Warren Buffett uses a version. Jim Simons built Renaissance technologies around it. It answers the million-dollar question: how much should I bet when I have an edge? Here's the practical formula professionals actually use. Optimal risk equals edge divided by odds times 0.25, where edge equals your expected win rate and odds equals your average win size. Real example time. Your system wins 60% with 1.5 to 1 reward-risk ratio, your edge. 0.60 times 1.5 minus 0.40 times 1 equals 0.9 minus 0.4 equals 0.5. Your odds, 1.5. Full Kelly. 0.5 divided by 1.5 equals 33% of your account. Hold on. Would you really risk 33% on one trade, even with positive edge? Of course not. This is why professionals use fractional Kelly. The professional secret Ed Thorpe pioneered Kelly in trading, but never used full Kelly. Why? Because he understood something the formula doesn't capture: human psychology. Full Kelly produces 50% drawdowns. Imagine losing half your account, being told this is normal, while your spouse threatens divorce and your confidence evaporates. Professionals use 25% of Kelly. It reduces maximum drawdown from 50% to about 15%. You sacrifice theoretical returns for psychological sustainability. That's not weakness, that's wisdom. Renaissance Technologies, the most successful hedge fund ever, uses about 10% of Kelly recommendations. They prioritize survival over optimization. Result: decades of compound returns. The hidden Kelly danger. Here's what destroys traders. Kelly assumes you know your exact edge, but markets evolve. Your execution varies. Stress affects performance. Your backtest edge isn't your real edge. Professional solution? Assume your edge is 30% worse than tested. If backtests show 0.5 edge, use 0.35 for Kelly. This conservative buffer has saved more accounts than any other rule. I've witnessed every blown account involve aggressive Kelly based on perfect backtests. Every surviving trader uses fractional Kelly with conservative estimates. Which would you rather be? Theoretically optimal but actually broke, or theoretically suboptimal but compounding wealth? If you've calculated your edge and sized appropriately, but still lose 10 trades straight, should you abandon ship? This brings us to understanding probability distributions. Chapter 4. Thinking in distributions. I'm about to say something that sounds insane. The result of your next trade is completely irrelevant. Win or lose, it doesn't matter. If results don't matter, how do I make money? By stopping focus on individual trades and thinking in sample sizes instead. The coin flip that changes everything. Grab a coin, flip it 10 times, you might get 7 heads, 3 tails, or 2 heads, 8 tails. Small sample, high variance, meaningless results. Now imagine flipping 1,000 times. You'll get approximately 500 heads, 500 tails, maybe 480 to 520 range. large sample, predictable distribution, meaningful data. Your trading works identically, yet most evaluate themselves after 10 trades. That's judging a coin's fairness after 10 flips. Mathematically illiterate. Statistical reality check. With a 60% win rate system, here's what's actually normal. 5 losses straight. 1.02% chance. Happens every 98 trades. 7 losses straight. 0.16% chance. Happens every 610 trades. 10 losses straight. 0.01% chance. Happens every 965 trades. But that's so rare. No, take 20 trades monthly, you'll hit these rare events regularly. When you do, will you abandon your edge or trust the distribution? Paul Tudor Jones nailed it. I'm always thinking about the distribution of outcomes. Not the next trade, the next 1,000 trades. Building your distribution map. Want something that will transform your trading forever? Calculate your expected ranges. For 20 trades with 60% win rate, most likely 12 wins, 8 losses. Normal range, 9 to 15 wins. Extreme possible, 6 to 18 wins. System broken, below 6 or above 18. Print this, post it by your monitors. During streaks, check your position. Normal range, continue. Extreme territory, reduce size but persist. Broken territory, stop and investigate. Professional versus amateur response. Amateur in losing streak. My system is broken. Markets changed. Need new strategy. Professional in losing streak. Trade 47 with 23 wins. That's 48.9% win rate. Expected range 45% to 55%. Within normal distribution. Continue execution. This isn't positive thinking, it's mathematical thinking. The difference between survival and failure. Quick reality check for you. During 2008's crisis, trend-following win rates dropped from 45% to 30% for months. Amateurs abandoned ship. Professionals who understood distributions stayed. When trends resumed in 2009, survivors made fortunes. The distribution always reverts. Always. Not because of mystical forces, because of mathematical law. Your job isn't predicting when, it's surviving until. Not because of mystical forces, because of mathematical law. Your job isn't predicting when, it's surviving until. Renaissance Technologies doesn't celebrate individual wins or mourn losses. They execute their edge across thousands of opportunities, knowing distribution will manifest. Can you develop the same mindset? Renaissance Technologies doesn't celebrate individual wins or mourn losses. They execute their edge across thousands of opportunities, knowing distribution will manifest. Chapter 5. The Drawdown Paradox. Paul Tudor Jones was crushing it, until he wasn't. One cotton position, absolute certainty it would work. 60% of his capital, gone. Chapter 5. The Drawdown Paradox. Paul Tudor Jones was crushing it, until he wasn't. One cotton position, absolute certainty it would work. 60% of his capital, gone. But what happened next is what matters. Jones didn't create better predictions. He created better rules. Never lose more than 2% on a single trade. Never average down. Wrong means out immediately. But what happened next is what matters. Jones didn't create better predictions. He created better rules. Never lose more than 2% on a single trade. Never average down. Wrong means out immediately. The result. From 1980 to 1988, compound returns of 100% annually. During 1987's crash, when the Dow dropped 22%, Jones made 62%, not 6.2%, 62%. The result? From 1980 to 1988, compound returns of 100% annually. During 1987's crash, when the Dow dropped 22%, Jones made 62%, not 6.2%, 62%. How? He stopped fighting probability. Jones later said, I think of myself as 50-50, either right or wrong. That keeps me from getting too confident or too scared. How? He stopped fighting probability. Jones later said, I think of myself as 50-50, either right or wrong. That keeps me from getting too confident or too scared. This is probability thinking personified, not I know what will happen, but I know my edge over 1,000 trades. This is probability thinking personified, not I know what will happen, but I know my edge over 1,000 trades. Statistical drawdown versus system failure. This distinction makes or breaks careers. Knowing normal drawdown from broken system. Statistical drawdown versus system failure. This distinction makes or breaks careers. Knowing normal drawdown from broken system. Statistical drawdown looks like stays within calculated maximum ranges. Trade execution remains consistent. Market conditions unchanged fundamentally. Win rate degradation under 2 standard deviations. Statistical drawdown looks like stays within calculated maximum ranges. Trade execution remains consistent. Market conditions unchanged fundamentally. Win rate degradation under 2 standard deviations. System failure looks like exceeds historical maximum by 50% plus. Multiple rules violated to save trades. System failure looks like exceeds historical maximum by 50% plus. Multiple rules violated to save trades. Market regime change, trending to ranging, win rate degradation over 2 standard deviations. Critical question, do you know your maximum expected drawdown? Without this number, you're flying blind. For 60% win rate with 1.5 to 1 reward risk, expected maximum drawdown is 18% to 25%. Hit 30%, rare territory. Hit 40%, something's broken. The psychological journey through drawdown. Days 1 to 3, denial, temporary setback. Next trade fixes everything. Days 4 to 7, anger, rigged market. Stops always hit before reversal. Week 2, bargaining. Just get me to break even. I'll be more careful. Week 3, depression. I'm not cut out for this. Everyone else makes it look easy. Week 4, acceptance. Here traders diverge. Amateurs quit or blow up. Professionals accept drawdown as business cost and continue. Building your drawdown survival system. Before your next trade, answer these. What's your maximum acceptable drawdown? What's your plan at 10% down? At 20%? At 30%? Without specific answers, you're unprepared for trading reality. Create automatic responses now while thinking clearly. At 10% drawdown, continue normal trading, increase journaling. At 15% drawdown, reduce position size by 50%. At 20% drawdown, trade minimum size or paper trade. At 25% drawdown, full stop, complete system review. These aren't suggestions, they're survival protocols. Learning from drawdown masters. Every legend has a devastating drawdown story. Ray Dalio lost everything in 1982, borrowed $4,000 from his dad to pay bills. Today, Bridgewater manages $150 billion. What separates survivors from casualties? Not avoiding drawdowns. Everyone has them. It's the response that matters. Survivors have plans. Casualties have hopes. Which are you building? Speaking of building, have you ever noticed how your identity shapes your trading results more than your strategy? Let me show you why. Chapter 6. Becoming a probability player. Stop what you're doing and write this down. I am not a trader. I am a probability player. This isn't wordplay. This is identity architecture, and it changes everything. The neuroscience of identity MIT research proves identity drives behavior more than willpower. When you say I am a trader, specific neural pathways fire, pathways associated with prediction, control, being right. When you say I am a probability player, different pathways activate. Pathways linked to process, statistics, mathematical acceptance. Change your identity, change your results. It's that profound. Trader versus probability player. The trader believes I predict movements, measures success by accuracy, responds to losses with, I failed, always asking, what will happen? The probability player believes I execute mathematical edges, measures success by process, responds to losses with normal distribution, always asking, am I executing properly? Feel the difference? One creates suffering, the other creates freedom. Your 30-day identity installation. Week 1, language reprogramming. Every morning, I am a probability player. I don't predict, I position, I don't hope, I calculate. Catch and correct language. Wrong, EURUSD will go up, right? EURUSD has 58% probability of rising based on my system. Week 2, decision reprogramming. Before every trade, what would a probability player do? Not what will happen, but Does this meet my edge criteria? Week 3, behavioral alignment. Calculate position size mathematically. Review trades on process, not profit. Celebrate perfect execution regardless of outcome. Week 4, environmental support. Unfollow prediction accounts. Follow systematic traders. Share probability insights publicly. Identity in action. Watch how this changes everything. Situation, stop hit. Market reverses immediately. Trader thinks, I got stopped at the exact bottom. I suck. Probability player thinks, my stop was statistically optimal. Sometimes the 20% outcome occurs. Same event, different identity, different response, different long-term results. Stanley Druckenmiller said it perfectly. It's not whether you're right or wrong, but how much you make when right and lose when wrong. That's probability player thinking. Ready to make the shift? Your survival depends on it. Chapter 7. Building your first probabilistic system. Most traders learn probability theory, but never build systems to implement it. Like reading fitness books without exercising. Knowledge without application equals zero. Do you have a written tested trading system right now? If you hesitated, you're trading on hope, not edge. Let's build a complete probability-based system, not theory. Actual rules you can trade tomorrow. The 7 essential components. Component 1, market selection. Trending markets suit patient probability players. Major Forex pairs. Indices during clear phases. Defined direction, manageable volatility. Ranging markets suit active probability players. Cross pairs, consolidating stocks. Frequent setups, smaller moves. Choose based on your life, not dreams. Only free during Asian session? Skip New York strategies. Component 2, time frame selection. Higher time frames mean fewer trades, larger moves, less noise. Perfect for part-timers. Lower time frames mean more trades, smaller moves, more noise. Full-timers only. Start with 4-hour or daily charts. Enough opportunity without overwhelming noise. Component 3, setup conditions. This separates probability players from gamblers. Specific measurable conditions that historically produce edge. Example, trend setup. Price above weekly high showing uptrend. Pullback to VWAP, showing potential support. Volume below average showing no heavy selling. ATR normal showing room to move. These aren't magic. They're filters increasing probability from 50-50 to 55-45 or better. Small edges compound into wealth. Component 4, entry triggers. Setup conditions show where, triggers show when. Example triggers. Price rejection at support zone. Volume spike on rejection candle. Enter at candle close. The key? Objectivity. Look strong isn't a trigger. Closed above previous high with above average volume is. Component 5, stop loss rules. Stops aren't failure admissions. They're probability insurance. Effective approaches, below rejection, candle low. 1.5 times ATR from entry. Maximum 2% account risk always. Probability players rule. Define stop before entry. No exceptions. Component 6, profit targets. Amateurs swing for fences. Probability players hit consistent singles. Target strategies. First target, 2 times ATR for half position. Second target, previous high for remainder. Component 7, trade management. Most edges die from poor management, moving stops early, taking profits quickly. Fear-based decisions. Probability management, set and forget, or mechanical trailing after 1 ATR profit. Complete system. Example. Let me show you a full system, not because it's best, but because it's simple and robust. Market, EUR, USD, GBP, USD, USD, JPY. Time frame, 4-hour charts. Direction, long only initially. Setup conditions, price above weekly high, confirming uptrend. Pullback to VWAP finding support. Volume below average showing controlled pullback. Within 3 ATR of VWAP preventing overextension. Entry trigger. Clear rejection at support level. Volume spike on rejection. Enter at candle close. Risk management, stop below rejection low or 1.5 ATR. Risk maximum 2% per trade. Reduce size if ATR expands 50%. Profit targets, first, 2 ATR for 50% position. Second, Previous high for remainder. Expected performance, win rate, 45% to 55%. Average win, 2.5 R. Average loss, 1 R. Expected value, plus 0.25 R per trade. Not sexy. Won't make you rich overnight. But compound 0.25 R over 1,000 trades, that's 250 R return. That's how wealth builds. Here's something interesting. Have you tracked how your trading changes throughout the day, throughout the week? Let me show you tools that reveal patterns you never knew existed. Chapter 8, Your Probability Toolkit. For the next few minutes, I'm giving you my exact daily tools. No theory, just practical probability weapons. Tool 1, the Expected Value Calculator. Build this in Excel today. Column A, trade number. Column B, win or loss. Column C, R multiple result. Formula calculates rolling 100 trade expected value. But here's the hidden gold. Track EV by time, day, and condition. The patterns will shock you. One student discovered plus 0.4 R edge during London, minus 0.1 R during New York. He stopped trading New York. Annual return improved 22%. One insight, massive impact. Tool 2, the distribution tracker. Create visual bands. Green, normal variance. Yellow, extreme but possible. Red, statistically improbable. Add heat mapping. Color code, each 10 trade segment. Patterns emerge. Maybe trades 31 to 40, always yellow. Month-end positioning, fatigue. The map reveals what numbers hide. Tool 3, the Kelly calculator. Simple version. Edge equals win percentage times average win minus loss percentage times average loss. Kelly equals edge divided by odds. Position size equals Kelly times 0.25. Advanced version, 3 calculations. Conservative using worst 50 trades. Realistic using average 100. Optimistic using best 50. Always use conservative during drawdowns. Tool 4, the tilt circuit breaker. Manual circuit breakers fail under pressure. Automate everything. Platform rules. 3 losses, reduce size 50%. 5 losses, stop for day. Daily limit, 2% maximum loss. Remove override ability. Future tilted, you will hate it. Your account will thank it. Tool 5, the probability statement. Write and record. I operate a system with X% win rate and Y reward risk, producing Z expected value per trade. Play your own voice stating mathematical facts every morning. Overwrites emotional reactions with statistical reality. Start with Tool 1 today. 10 minutes to build. Backtest your last 100 trades. The number might shock you, but reality beats delusion every time. Now let me share something that will inspire you. Real billionaires who think exactly like this. Chapter 9, Real Billionaires Who Think in Probabilities. Paul Tudor Jones went from blown account to $7.2 billion. Ed Seikoda turned $5,000 into $15 million. Stanley Druckenmiller averaged 30% for 30 years without a down year. What's their secret? They all learned probability thinking through pain, then never forgot the lesson. Paul Tudor Jones. From disaster to billions. After losing 60% on cotton, Jones rebuilt with one principle. I'm always thinking about losing money as opposed to making money. His framework, risk 1% to 2% maximum, seek 5 to 1 profit factor minimum, assume wrong until proven right. But here's what most miss. Jones doesn't just think trade probabilities, he thinks career probabilities. I've missed opportunities being conservative, but I'm still here after 40 years. Meta probability thinking, not what are odds this trade works, but what are odds I'm trading in 20 years. Jones optimized for the second. Ed Seikoda, the trend, following legend. Started with $5,000 in 1972. By 1988, $15 million. His secret, win or lose, everybody gets what they want from markets. Seikoda's deepest insight. The biggest secret about success is there isn't any big secret. You need rules and discipline to follow them. Translation. Probability thinking isn't complex. It's simple rules executed relentlessly. Complexity is ego protection, not edge enhancement. Stanley Druckenmiller, Soros's right hand. Averaged 30% returns for 3 decades. Never had losing year. His insight. It's not whether you're right or wrong, but how much you make when right and lose when wrong. This is probability thinking, not binary right-wrong, but distributed outcomes. Amateurs focus on being right. Billionaires focus on payoff distribution. The common thread. All three had major failures before success. Jones lost 60% on cotton. Seikoda blew multiple accounts. Druckenmiller lost big picking 1987 bottom. The difference? They learned probability thinking from pain, paid market tuition, then applied lessons for decades. Modern probability masters. Ray Dalio built the world's largest hedge fund on radical transparency about probability. Every trade has written probability assessment, not to be right, but to calibrate thinking. Jim Simons hired zero traders at Renaissance, only mathematicians and physicists. Why? Traders predict. Scientists calculate probabilities. Result: best track record in history. Your transformation starts today. Stop predicting, start calculating. Stop hoping, start executing. Stop gambling, start compounding. These billionaires aren't smarter than you. They just learned probability thinking earlier and executed longer. Your fortune is thousands of probability-based trades away. But what happens when you know all this and still can't follow it? When emotion overrides logic? Let me prepare you for that battle. Chapter 10. Mastering Probability Tilt. Let's address the elephant in the room. The moment probability thinking fails. You know the math, understand distributions, but you're on tilt, and knowledge evaporates. The neuroscience of trading tilt. Research shows financial losses trigger the same brain regions as physical threats. Your amygdala hijacks your prefrontal cortex. Probability thinking becomes impossible. But tilt has predictable stages you can defend against. Stage 1, the whisper, checking P&L obsessively, running what-if scenarios, brain weakening but still in control. Stage 2, the shout, breaking minor rules, increasing size slightly, searching for new setups, emotion gaining ground. Stage 3, the scream, major violations, massive positions, pure revenge trading, full amygdala control. The probability tilt protocol. For stage 1, stand immediately, walk away 5 minutes, do 20 push-ups. State aloud, I'm experiencing micro tilt. My next trade has identical expected value regardless of recent results. For stage 2, mandatory 1-hour break. Exercise intensely 20 minutes. Write exact rules you're tempted to break and why. For stage 3, emergency shutdown. Close everything immediately. 72-hour mandatory break. Full review required before returning. Pre-tilt detection, track daily, sleep quality below 7, increases tilt 40%. Stress above 6, increases tilt 35%. Recent losses, 3+ increases tilt 60%. 2 yellow indicators, implement preventive measures. Trade 50% size, mandatory breaks between trades. Building tilt immunity. True immunity comes from identity shift. When you are a probability player, tilting against math becomes as impossible as tilting against gravity. But identity alone isn't enough. You need systems protecting you from yourself. Every blown account I've witnessed involves someone knowing they were tilting, but continuing anyway. Every survivor had automatic shutdowns, removing choice from the equation. Which will you build? Hope-based discipline that fails under pressure, or systematic protection that saves you from yourself? Your survival depends not on discipline in calm moments, but preparation for chaotic ones. Build your tilt defenses now. When tilt arrives, it's already too late. Chapter 11. The compound effect of probability. Everyone wants the 90% win rate holy grail. But let me show you why a mere 55% edge creates massive wealth. The mathematical reality, $10,000 account, 55% win rate, 1-to-1 risk-reward, 2% risk per trade. Year 1, approximately $14,000, plus 40%. Year 3, approximately $27,000, plus 170%. Year 5, approximately $53,000, plus 430%. Year 10, approximately $280,000, plus 2,700%. A 5% edge above random, compounded consistently, creates exponential wealth, not through prediction, through probability harvesting. The compound psychology journey. Year 1, every trade feels monumental. $4,000 gain feels both huge and tiny. constant temptation to increase risk for faster gains. Years 2 to 3, the grind phase. Account growing but slowly. Friends making more in crypto. Doubt creeps in. Is this worth it? Years 4 to 5, acceleration begins. Same percentages create larger dollars. Confidence solidifies. You start believing. Years 6 to 10, exponential phase. Daily swings exceed entire year 1 profit. You finally understand why Einstein called compound interest the eighth wonder. Why most fail to compound. They lack real edge, never calculated it. Trading on hope and feelings. They don't protect edge. One aggressive trade wipes months of gains. They don't execute consistently. System says trade, fear says wait. They don't maintain edge. Markets evolve, systems need refinement. But the biggest reason, they don't understand the time component. The time arbitrage. Wall Street thinks quarters. Retail thinks days. Probability players think decades. This time arbitrage is your edge. While others abandon systems after bad months, you're executing trade 847 of 10,000 planned trades. 2 traders, same start, same system. Trader A switches strategies every 6 months chasing returns. After 10 years, $18,000. Trader B, same boring system for 10 years, $280,000. Same skill, same markets, different time horizons, different destinies. Your compound future. Think about this. If you're 30 and compound at 40% annually until 60, starting with $10,000, you'll have over $10 million. Not through prediction, through probability, through patience, through process. The question isn't whether compound math works. It's whether you have patience to let it work. Starting today, calculate your true edge, protect it with proper sizing, execute it without emotion, compound it relentlessly. In 10 years, you'll either be explaining compound returns to others or explaining why you kept switching systems. The choice is made today, one trade at a time. Chapter 12, your 90-day probability transformation. You've learned the theory. Now here's your exact transformation roadmap. Days 1 to 30, foundation. Phase. Week 1, calculate your current reality. Export last 100 trades. Calculate win rate, R multiples, expected value, maximum drawdown. Face truth. If expected value is negative, you've been gambling, not trading. Week 2, build your tools, create EV calculator, design distribution tracker, build Kelly calculator, create daily workflow. No perfection needed, just functionality. Week 3, identity installation. Write, I am a probability player. 20 times each morning, correct prediction language. Take only trades meeting all criteria. Size by Kelly only. Week 4, live implementation. Trade 0.5% risk maximum. Focus entirely on process. Track adherence scores. Plan month 2 improvements. Days 31 to 60. Integration phase. Increase to 75% normal size. Add psychological metrics. Implement tilt protocols. Begin correlation tracking. Process scores must average 8+ to continue. Days 61 to 90. Mastery phase. Return to full sizing. Begin teaching someone else. Review all data. Make minor adjustments. Plan next 1,000 trades. Days 1 to 10. This is too much work. Focus on one tool at a time. Progress beats perfection. Days 20 to 30. I'm not seeing results. You're building foundation. Houses aren't built in a month. Days 40 to 50. I was doing better before. Normal resistance. Old patterns fighting death. Push through. Days 70 to 80. I've got this figured out. Danger zone. Stay humble to mathematics. Around day 75 to 85, something shifts. You stop forcing probability thinking. It becomes natural. You catch yourself analyzing restaurant wait times and distributions. You see probability everywhere. This is the moment. You're no longer learning to be a probability player. You are one. Day 91 begins your career as a probability player. Not a test, not a trial. Your professional journey. The 90 days taught you how to think. The next 1,000 trades prove you can execute. One trade at a time, one distribution at a time, one compound curve at a time. Remember where we started? Paul Tudor Jones, devastated. 60% of capital gone in a single cotton trade. Fast forward to today. He's worth $7.2 billion. Not because he learned to predict cotton prices, because he learned to think in probabilities. Over the past 90 minutes, you've discovered why your brain fights probability and exactly how to overcome it. The mathematical edge hidden in losing systems that actually print money. How to size positions for optimal growth without blowing up. Why individual trades don't matter, but distributions always do. The identity shift from trader to probability player that changes everything. You now stand at the crossroads. Path 1. Return to prediction. Keep fighting randomness, trade on gut feelings. Hope for the best. Join the 90% who donate to markets. Path 2. Embrace probability. Partner with randomness, trade on mathematics. Compound your edge. Join the 10% who harvest from markets. 2 futures, 1 choice. 1 year from now on, Path 1. Still searching for the perfect pattern. Account down 20% or blown and reloaded twice. Tried 6 different strategies, each abandoned after drawdown. Blaming markets, brokers, manipulation. Considering quitting. 1 year from now on, Path 2. Executing trade, 847 of your 1,000 trade campaign. Account up 40% with maximum drawdown of 12%. Same boring system. Same mechanical execution, same consistent results. Checking account monthly, not daily. Trading takes 30 minutes per day, sleeping peacefully. The difference? Not intelligence, not capital, not luck. Just the decision to stop predicting and start playing probabilities. Your immediate action plan. Right now, before inspiration fades, before old habits reassert control, take action. Step 1. Download your free Probability Players Toolkit. Link in the description. Includes the exact expected value calculator I use daily, Kelly position and sizing spreadsheet that protects your capital, distribution and tracker that reveals your true edge, and complete 90-day transformation checklist. These aren't generic templates. They're the exact tools that transform my trading and thousands of others. Free because probability players help each other succeed. Step 2. Make your public declaration. Type in comments below, I am a probability player. This isn't just words, it's commitment. Public declaration creates accountability. Your subconscious takes seriously. Plus, you'll connect with others on the same journey. Want to accelerate your transformation? Add why you're making this shift. What finally convinced you to stop predicting and start calculating? Step 3. Start your first campaign today. Open your platform. Begin trade 1 of your first 100 trade campaign. Not tomorrow, not Monday, today, right now. Campaigns start with decision, not perfection. Your first trade as a probability player matters less than the commitment to think differently. The wisdom that matters. Paul Tudor Jones reminds us, most important thing is how good are you at risk control, not prediction. Risk control, not certainty. Probability. Ed Seykota distilled it perfectly. Elements of good trading are cutting losses, and cutting losses. Not finding winners, surviving to compound. Stanley Druckenmiller gave us the mantra. It's not whether you're right or wrong, but how much you make when right and lose when wrong. Your evolution begins now. You don't need to be Paul Tudor Jones. Don't need billions. Just need his framework. Accept you can't predict. Focus on risk, not reward. Think in samples, not singles. Let probability work over time. Markets have tested millions of traders across centuries. Survivors all discovered the same truth. Probability beats prediction. Edge beats accuracy. Time beats timing. Mathematics beats emotion. You now have the knowledge, the tools, the framework, the community. Everything needed for transformation. Except one thing. The decision to begin. The final truth. Tomorrow, markets open again. Millions will try predicting direction. Thousands will claim certainty. Financial media will pretend to know. Patterns will flash everywhere. Gurus will sell systems promising prediction. But you'll smile because you know something they don't. You don't need to predict anything. Just position for probability. Over time, over trades, over years, probability always wins. Not sometimes. Always, not maybe, definitely, not hopefully, mathematically. This isn't positive thinking. It's mathematical law. Casinos don't hope. They execute probability. Insurance companies don't predict. They calculate distributions. Professional traders don't gamble, they harvest edge. Welcome to your new identity. Say it one more time. I am a probability player. Feel different? You should. No longer trying to beat markets, partnering with probability. No longer fighting randomness, flowing with it. No longer seeking certainty. Embracing uncertainty profitably. If you've made it this far, you're different from 90% who clicked away seeking easier answers. There are no easier answers, but there are better answers, and you've just spent 90 minutes absorbing them. Welcome to the world of probability players, where math beats emotion, where consistency beats brilliance, where compound curves create wealth, where sleeping peacefully becomes normal, where trading is boring and life is exciting. Your transformation didn't start when you clicked this video. It started the moment you chose to stop predicting. Your profits won't come from being right. They'll come from playing probability correctly. Markets don't care about your predictions. Never have, never will. But they pay probability players forever. Your probability future begins with your next trade. Make it count. Not because it needs to win, because it needs to follow your edge. Trade 1 of 1,000 starts now. Execute your edge. Trust the math. Compound your future. The decision that changes everything isn't complex. Stop predicting. Start positioning. Stop hoping. Start calculating. Stop gambling. Start compounding. Simple? Yes. Easy? No. Worth it? Ask any probability player living their dream life, funded by Mathematical Edge. The journey from trader to probability player begins now. Not with perfection, with decision, not with certainty, with courage to embrace uncertainty profitably. Markets are waiting. Probability is waiting. Your transformed future is waiting. Only question: are you ready to stop predicting and start winning? Welcome to your probability future. It's mathematical. It's inevitable. It's yours. Execute your edge. The rest is just time.